The primary market corporate credit facility and the secondary market corporate credit facility are two of the programs established by the Federal Reserve to support the economy through the coronavirus pandemic. Together, these facilities are intended to provide support for U.S. companies that employ a large number of workers and finance themselves by issuing debt into capital markets. But what does it mean when a company issues debt? Why are corporate bond markets important to the U.S. economy as a whole? And how do the primary market corporate credit facility and the secondary market corporate credit facility actually work? One way that companies fund their operating expenses is by issuing debt in the form of corporate bonds. These corporate bonds are a form of corporate IOU in which the company is borrowing money from investors. In exchange, investors expect to receive regular interest payments from the company over the life of the bond and, at maturity, receive back the full amount of their original investment. Corporate bond markets represent an important source of funding for large companies in the United States, and maintaining access to this funding is particularly important during times of economic strain. When an unforeseen, significantly disruptive event occurs, a company may have difficulty refinancing its maturing debt and issuing new bonds. As a result, it may have to consider measures such as layoffs or budget cuts in order to avoid defaulting on its debt obligations. Even the possibility of default may cause investors to stop buying a company's bonds or demand much higher interest payments, which pushes the risk of default even higher. If a potential default involves a large U.S. company, the result could mean job losses for tens of thousands of employees, as well as disruptions to its suppliers and vendors. That's where the primary market corporate credit facility comes in. Through the primary market corporate credit facility, the Fed provides a funding backstop directly to creditworthy U.S. companies by purchasing newly issued corporate bonds that meet certain criteria. This provides relief to eligible companies from temporary market pressures and allows them to continue issuing debt to fund their operating expenses as normal. When a company issues a corporate bond, the bond becomes an asset that investors can trade on the secondary market. The value of the asset is derived through the bond's ongoing returns to the investor, as well as the perceived creditworthiness of the company issuing it. Together, these encourage investors to continue purchasing newly issued corporate debt. If, however, an unforeseen event discourages investors from trading corporate bonds, it can also cause them to stop purchasing newly issued debt, which reduces financing for companies. Through the secondary market corporate credit facility, the Fed seeks to reduce the risk of such disruption by providing liquidity to the corporate bond market itself. The Fed does this by purchasing corporate bonds issued by creditworthy U.S. companies, as well as U.S.-listed exchange-traded funds, or ETFs, that provide broad exposure to U.S. corporate bond markets. These broad-based asset purchases keep the secondary market functioning as normal, so that companies are able to issue debt to fund their operating expenses. Like other investors in the corporate bond market, the Fed receives regular interest payments on purchases made through the corporate credit facilities and, at maturity, receives back its original investment. By encouraging the financial well-being of large U.S. companies amidst temporary market pressures, the Federal Reserve is supporting the employees and suppliers who depend on them, as well as the U.S. economy more broadly.